Hey everyone, welcome back to the Strategic UTXO. My name is Matt, and in this video, we're going to talk about what the Fed just did this last week. I know a lot of people talk about this these days, but I want to focus on the QE basically pause that we got, or the massive reduction in QE, what that means for inflation, what that means for future rate cuts, what that means for the Fed's balance sheet moving forward when it comes to mortgages and treasuries and corporate bonds, and ultimately, at the end of the day, how does this impact Bitcoin moving forward? Are we going to start to see a recovery, or are we going to continue to head lower? So that's what we're going to look at in this video. If you want to become a premium member to receive my Strategic UTXO newsletter along with the private videos, then check out the link in the description below. Okay, so the Fed met a few days ago, and unsurprisingly, they kept the federal funds rate the same. So the prime rate stays the same on HELOCs, on credit cards, on business loans, on general LOCs. The prime rate remained unchanged. But the one thing that was very important to note was that beginning in April, one thing they're going to start doing is they're going to reduce their security sell-off from 25 billion down to 5 billion, which is a massive reduction. Beforehand, I believe it was like 50 or 60 billion dollars per month that they were letting roll off their books. Now, what that means is that if they have, $50 billion worth of, let's say, 10-year treasuries, in order to keep their balance sheet the same size, they would need to repurchase those treasuries when their current holdings matured and they received the principal back. They would go re-enter the market again and buy those treasuries. Their balance sheet would remain the same size. Instead, what we have seen practically, when did they start this? Yeah, middle of 2022, they were at $9 trillion, and they have successfully, and nobody really thought this was possible, they successfully shedded $2 billion from their balance sheet. Now, this comes mainly in the form of government bonds. However, with the QE, the quantitative easing programs and these purchase programs that they put in place all the way back in QE1, QE2, QE3, and then finally QE4, which happened during COVID, they bought up a lot of corporate debt and a lot of mortgage-backed securities. Now, recently, one of the things that I think is so fascinating, and I work in the housing industry for my day job, but a lot of people are waiting for homes or waiting for mortgages to come, for their interest rates on mortgages to come back down to like 2.75 or 3.5 or even 4%, which I don't think we are ever going to see that, barring a financial crisis to the same magnitude of 1929 or 2008. And the reason is the Fed was, when they purchased mortgage-backed securities, they are then subsidizing lenders, and so lenders know that, hey, if I write this loan, if I write this mortgage, it gets underwritten, it gets approved. They know they can sell it super easily because they have a buyer at the Fed who's just going to buy this mortgage-backed security. And so because of that, you have these the premium compression in the you'd have your 10-year bond, and then you add like 1.5 to 2% on top of that. That's how you get your, I guess, even potentially a little bit more than that if there's some uncertain times, to get your mortgage rate. So you have a 4.5% 10-year, you're going to have 6.5 to 7% mortgages. You have a 2 to 2.5% premium on top of that. So when you have the 10-year that's all the way down to 1%, and you have the Fed that's willing to buy up these mortgages, then that premium can come down to 1.5%. And so the Fed is basically subsidizing all of these loans that are being written. So not to go off on too much of a tangent, I talk about this all day long, but the Fed has communicated that they, going forward, if they have these asset purchase programs, they're not interested in buying mortgage-backed securities. What they're going to do is they're going to be a backstop for Treasury, for T-bills, for, I guess, particularly long-dated U.S. Treasury bonds, and they have much less interest in backing mortgage-backed securities and even corporate debt to an extent as well. So moving forward, if there are QE plans, it will be for debt. They will be basically monetizing government debt, and they're kind of letting the housing market do its thing. That's also one of the reasons why I'm not super bullish on housing. We actually just sold our house, more of a lifestyle change, but also, one way for us to, make a statement in the market. Hey, we don't want this house anymore. We're much happier just to rent and put that money to better use. So that's what we see here. So when we see that their securities roll off is decreasing from 25 billion currently to 5 billion starting in April, probably on April 1st, what that means is that they are going to allow these treasuries to roll off their books at a rate of 5 billion. So we've seen this massive increase in right around here early last year to be probably 10 to 11 months different in this this drawdown. You see that the rate of change, although still relatively severe, changes slightly, and you have this trajectory change, and it's the treasury or the balance sheet roll off has been slower. Now, once we get to 5 billion, that's basically a neutral stance. Now, one of the things that's important to note is once they get rid of that 5 billion number here, and they let's say they go to zero, they basically stop quantitative tightening. We're done. What that means is that this balance sheet will basically start to go sideways until something major happens. And that is not necessarily a bearish thing. We don't need to see a hockey stick for the Fed's balance sheet in order to have positive impact in markets. So what we see right now is the Fed is just not repurchasing some of their treasury holdings. What happens is when they go neutral, when they are no longer doing QT, but they're still not doing QE, in order to maintain the same balance sheet size, let's say $7 trillion is their balance sheet size that they want to maintain. If they have a 10-year treasury that matures and it rolls off their books, what they're going to do is then enter the market and purchase another treasury to then keep the balance sheet at the same size. So yes, technically it's not quantitative easing because there's not an increase in the balance sheet, but there is a purchase program inherent within that because all of these assets they expire, they mature, and then they roll off the books and they get their principal back. And so what's going to be interesting is to see what kind of dynamic that has on the market. Now, people are expecting these massive moves and a massive start to QE. Obviously, not a fan of central banks as a Bitcoiner. Post COVID, like starting in 2022, the Fed has done a decent job. And obviously, if a financial crisis happens, I'll eat my words. They've done a decent job at managing this roll off. This was obviously way too severe, right? And they've been able to an extent, reduce it. So, staying the same, Fed's balance sheet is probably going to decline a little bit more, but we're probably going to level off here around 6.75 trillion. And then as we see that stabilize, we're going to see them purchase securities. Okay, one thing that's interesting is with the language here, the May meeting, the CME futures here is projecting a 15% chance for a rate cut. I'm assuming we're probably going to keep this pause as markets are going to probably be in limbo. But in June, there is a 72 to 73% chance, so greater than 2/3 chance that we do see another rate cut. And then into July, we have a 35% chance that we see a second rate cut or a pause. And so one thing that's interesting about this rate cutting cycle is that in historic Fed cutting cycles, when they start cutting, they don't stop until the economy rebounds, and then rates have to rise to combat the growth, the very hot growth and inflation that comes, and it's this pattern. But with Powell, they dropped a little bit, they've paused, and they might drop one more time and then pause again. And so this is really an interesting time in markets because we really haven't seen this. And I think we're probably going to see that cut in June, because if you look at the Truflation numbers, it shows that, just even at 2 weeks ago, we were at 1.3, 1.4% inflation. Now we're up to 1.7, which is the lowest reading we've had in a very long time. And so I think this is probably going to start to increase again. I'll probably go back over 2%. But the point is that the trend has been down. When did the new administration start? At 3%, and then it crashed all the way back down to 1.3. And that's probably consumer sentiment, but still, that's a very, crazy impact. So what does this mean for Bitcoin? In the short term, all it gives when the Fed is not doing QT or when they're doing QE, what it signals to the market is saying, hey, when it comes to treasuries, this is what they call the Fed put. When market participants are worried about the economy, let's say they have a portfolio of $100. They could, if they're worried about the economy, sell 10% of their portfolio, $10 worth of stocks or bonds or whatever, and then buy puts. So they can buy puts to protect and hedge the other 90% of their portfolio. when we talk about the Fed put, what that's saying is that the Fed is then entering them, or the Fed is basically acting as that put. So then market participants don't have to sell the risk assets or sell stocks to then buy puts to protect the rest of their portfolio. The Fed is doing that role. And so when we talk about QE, what that means is that in times of worry and panic, investors, they run to treasury bonds. They run to these government bonds. And we're on the 10-year here, and I'll make all these white so we can see them. This is the 10-year yield, right? So investors run to treasuries. And so if the Fed is purchasing them, right, to keep the balance sheet at the same size, or they have a purchase program to increase their balance sheet, then that's when regular market participants within the economy can be like, okay, well, the Fed's got that. They're the ones buying bonds. And by the way, that doesn't necessarily mean that rates go down. Typically during QE programs, I mean, of the few that we've had, rates actually go up, but that's a conversation for another time. But then you have stocks that are free to then rise at the same time. And so what I think that this means is, I mean, I'm bullish Bitcoin. I flip bullish again at like 81,000 down here. I have very tiny cash position for limit orders when we have dips. But I know I posted this a few nights ago, or actually this was last week. Man, time flies. I got rid of all my limit orders and I purchased Bitcoin at like 81.8, I think it was. And I had a much larger purchase over here at 78.5. I'm generally bullish on Bitcoin. I think we're going to end the year well over $100,000. I am a cycle skeptic, and we'll talk about that in future videos. But I think with the Fed pivoting, I think with Bessent at the helm of Treasury and Trump with all their tariff talk or whatever, I think the market is going to be soothed, if not here in Q2, then definitely in Q3 and Q4. I think we could see this turn as early as April. And I think April could actually, or Q2, so April, May, and June, could be very good months for Bitcoin, especially after a very disappointing Q1. I mean, we started at 96,000, I think. Let's see. The close on Tuesday here was 93.3. And so we're down about $9,000 on the quarter. I kind of think we're going to be at a new all-time high. This is more of a Dixie prediction. I think we're going to be at a new all-time high by the end of Q2. So what does that put us like over here somewhere? No, I'm not saying we're going to be at 150 or 200K, but I think we're going to be good. And I think that, after that, we'll probably have some summer doldrums. It's going to be quiet and boring. And then, we'll see if growth picks up in the fall here and we can make a push towards 150K, maybe even 200K. But I'm generally constructive here for Bitcoin. I think everything looks really solid for the economy. I don't see a recession on the horizon. I see a shakeup in the market with what Doge is doing and Trump is doing, and we'll talk about what Bessent's doing with Treasury issuance and T-bill issuance. He's continuing what Yellen is doing. So kind of these QRFs are going to be really interesting, or the quarterly funding reports, QFRs, that he'll put out. So we'll have to get a sequence of those to see where he's going to lean when it comes to Treasury issuance and allowing commercial banks to basically monetize and finance government debt. So we'll see all that going forward. Thank you guys so much for watching. Check out the Strategic UTXO. This week we're talking about the MOVE index when it comes to bond volatility, how that impacts liquidity. I don't think global M2 at its face value is a very good metric for looking at that. So we're going to evaluate the MOVE index and what that tells us about liquidity moving forward. And that's also what leads me to my bullish prediction for Q2 and even into the end of the year. So thank you so much for watching, and I will see you in the next video.